Before we dive in, a quick but important reminder. I am not a financial advisor, a mortgage broker, or a licensed professional in the financial industry. This presentation is for educational and informational purposes only and should not be considered financial, legal, or investment advice. The housing and mortgage markets are complex and subject to rapid change. Always consult with a qualified professional before making any financial decisions. Your financial situation is unique, and the information presented here may not be suitable for your specific circumstances. Imagine this for a second. You've done everything right. You saved for years, you polished your credit score until it gleamed, and you spent countless weekends dragging your family to open houses. Finally, you find it. The one. The house with the perfect backyard for the dog. In the school district you wanted, with that home office space you've been dreaming of. You're ready. You call the lender you spoke with just 3 months ago, buzzing with excitement, only to hear a number that makes your stomach drop. The interest rate they quoted you. It's a full percentage point higher. Suddenly, the monthly payment on your dream home isn't just a stretch. It's a nightmare. It's $400, $500, maybe even $700 more per month than you had budgeted for. That's thousands of dollars a year vanished. Your dream is suddenly on the verge of becoming a financial prison. What happened? Why did the ground shift so violently from under your feet in just 90 days? You'll hear a lot of vague answers. You'll hear, oh, the Fed raised rates. You'll hear, it's just inflation. You'll hear, the market is crazy right now. And while those things aren't exactly wrong, they're useless. It's like saying a car moves because of the engine. It's true, but it tells you nothing about the spark plugs, the fuel injectors, the transmission, or the 100 other components that actually make the wheels turn. Telling you the Fed moved rates is telling you the news of yesterday. It doesn't help you see what's coming tomorrow. The raw truth is that the vast majority of homebuyers, and even many real estate professionals, are flying completely blind. They are reactive. They wait for the headlines to tell them what has already happened. But the people who truly understand the market, the institutional investors, the bond traders, the heads of the lending banks, they aren't looking at the headlines. They're looking at the dashboard. They're watching a handful of specific economic indicators that telegraph weeks and even months in advance where mortgage rates are headed. And today, I'm giving you access to that dashboard. In this video, I am going to pull back the curtain and demystify the forces that actually drive your mortgage rate. We're going to cut through the noise and focus on the signal. I'm going to show you the key economic reports, explain what they mean in plain English, and show you exactly how they connect to the number you get quoted by a lender. By the end of this, you will no longer be a passenger tossed around by the whims of the market. You will be a co-pilot. You will understand the why behind the rate changes. You'll be able to spot the warning signs of a rate hike before it dominates the news cycle, and more importantly, you'll be able to recognize the green shoots of a rate drop, giving you the knowledge to time your purchase or refinance to potentially save you tens or even hundreds of thousands of dollars over the life of your loan. So where do we begin? We start with the arch nemesis of every lender, the single biggest driver of interest rates in the modern economy: inflation. Think about it from a lender's perspective. A bank is giving you a huge pile of money today, and you're promising to pay them back over the next 30 years. Their biggest fear is that the money you pay them back with in the future will be worth less than the money they gave you today. That's what inflation does. It erodes the purchasing power of money over time. If inflation is running at 3%, the dollars they get back from you next year are worth 3% less. To protect themselves from this loss, they have to charge you a higher interest rate. It's a risk premium. High inflation equals high risk for the lender, which equals a high mortgage rate for you. It's that simple. So how do we measure this beast? The number one indicator, the one that makes the entire financial world stop and hold its breath every month, is the Consumer Price Index, or the CPI. The Bureau of Labor Statistics releases this report every month, and it's essentially the nation's report card on inflation. They create a theoretical basket of goods and services meant to represent what the average American urban consumer buys. This basket has everything in it: gasoline, groceries, rent, used cars, airline tickets, haircuts, you name it. The CPI report then tells us how much the price of that entire basket has changed from the previous month and from the same month last year. When you see the CPI report, you'll hear two main numbers: headline CPI and core CPI. This is a critical distinction. Headline CPI includes everything in the basket. Core CPI strips out two very volatile components: food and energy. Why would they do that? Because gas prices can spike for a month due to a hurricane in the Gulf or a conflict overseas and then fall right back down. Food prices can jump because of a bad harvest. These are noisy signals. The Federal Reserve and, more importantly, the bond market, which is where mortgage rates are truly born, they want to see the underlying sticky trend of inflation. They want to know if prices are rising broadly across the economy in a way that's hard to reverse. That's what core CPI shows them. Think of it this way: headline CPI is the weather. It can be a freak thunderstorm today and sunny tomorrow. Core CPI is the climate. It's the long-term pattern. A bank isn't going to set a 30-year mortgage rate based on today's weather. They're going to set it based on their forecast for the climate. That's why the market often has a much bigger reaction to the core CPI number. So, your first rule of forecasting rates is this: watch the core CPI report like a hawk. When it comes in hotter than expected, meaning prices are rising faster than economists predicted, you can almost feel the upward pressure building on mortgage rates. Bond traders start selling, which pushes their yields up, and mortgage rates follow suit almost immediately. Conversely, if the core CPI report comes in cooler than expected, showing that inflation is taming, it's a green light. It signals that the pressure is easing, and it creates an environment where rates can begin to fall. Understanding this one report alone moves you from the little leagues to the big leagues. It's the foundational piece of the entire puzzle. It tells us the story of what has happened. But it's not enough. CPI is a look in the rearview mirror. It tells us how fast we were going, but not where the road is turning up ahead. To see the future, we need to look at the indicator that acts as the heartbeat of the global financial system. The one that has a more direct and immediate impact on your mortgage rate than any other single number in the world. And that indicator is the 10-year Treasury yield. So let's break this down. A 10-year Treasury is, at its core, a loan. It's an IOU from the United States government. When you buy a Treasury bond, you are lending money to Uncle Sam. In return, the government promises to pay you a fixed interest payment twice a year, and then give you your original money back in exactly 10 years. Simple enough. But why is this specific loan, this particular IOU, so ridiculously important? Because it's considered the safest long-term investment on planet Earth. Period. The US government has never ever defaulted on its debt. It has the largest economy in the world and, crucially, the power to tax its citizens and, in a pinch, print more money to pay its bills. So, when a massive pension fund, a foreign government, or a giant insurance company needs a place to park billions of dollars where they are virtually guaranteed to get it back, they buy US Treasury bonds. This makes the interest rate, or the yield, on that 10-year Treasury bond the global benchmark for a risk-free return. It's the baseline. It's ground zero for finance. Now, here's the part that trips a lot of people up, but it's absolutely critical to understand. The yield on this bond moves every single day, even though the interest rate printed on the bond itself is fixed. How is that possible? It all comes down to simple supply and demand. These bonds are traded on the open market just like stocks. Imagine the government issues a bond for $1,000 that pays 3% interest. If the economy suddenly looks shaky and investors get scared, they all rush to buy these super safe government bonds. This huge surge in demand drives the price of that $1,000 bond up. Maybe it now costs $1,050 to buy it on the open market. But remember, the government is still only paying that original 3% on the initial $1,000. So for the new person who paid $1,050, their actual return, their yield, is now lower than 3%. The price went up, so the yield went down. The reverse is also true. If the economy is booming and investors want to chase higher returns in the stock market, they sell their boring, safe government bonds. This flood of supply pushes the price of the bond down. Maybe that $1,000 bond now only costs $950. The government is still paying that same fixed interest, but for the new buyer who got it at a discount, their effective return, their yield, is now higher than 3%. The price went down, so the yield went up. This inverse relationship between price and yield is the engine that drives everything. Okay, so a bunch of investors are trading government IOUs. What in the world does this have to do with the 30-year fixed-rate mortgage you're trying to get for a house in suburbia? Everything. Imagine you are a mortgage lender. Your entire business is built on lending money for long periods and managing risk. You need to decide what interest rate to charge someone for a 30-year loan. What's your starting point? Your absolute baseline? You look at the 10-year Treasury yield. You see that you could lend your money to the US government, the safest borrower in the world, and get, let's say, a 4% return guaranteed. So when you come along asking for a 30-year mortgage, the lender thinks, why would I lend money to this individual person for 30 years at 4%, when I can get that same 4% from the US government with practically zero risk of default? The answer is they wouldn't. They need to be compensated for the extra risk they're taking on by lending to you instead of the government. This is where the magic happens. Your 30-year fixed mortgage rate is, in essence, the 10-year Treasury yield plus a spread. That spread is the lender's profit margin and their compensation for all the additional risks. What risks? The risk that you might lose your job and default on the loan. The risk that inflation over the next 30 years could be higher than they expected, eating away at the value of their return. The administrative costs of servicing the loan for 3 decades. All of these factors get baked into that spread. This is why, if you pull up a historical chart, you will see the line for the 30-year mortgage rate and the line for the 10-year Treasury yield moving in an almost perfect synchronized dance. When the 10-year yield goes up, mortgage rates go up. When the 10-year yield goes down, mortgage rates go down. It's not a coincidence. It's a direct causal relationship. The 10-year Treasury acts as the gravitational pull, and mortgage rates are in its orbit. So the billion-dollar question becomes, what makes the 10-year Treasury yield itself go up or down? What are the forces that cause all those global investors to either rush into the safety of U.S. bonds or flee them for riskier assets? There are 4 main drivers. First, and most importantly, is inflation expectations. If investors believe that inflation is going to be high over the next 10 years, they will demand a higher yield on their Treasury bonds to compensate for the fact that the money they get back in the future will be worth less. If they expect 3% inflation, they won't accept a 2% yield. They'd be losing money. So fear of future inflation is the #1 driver that pushes yields, and therefore mortgage rates, higher. Second is the Federal Reserve. While the Fed doesn't directly set the 10-year yield, its policies have a massive influence. When the Fed raises its short-term interest rate, the federal funds rate, it signals a fight against inflation and a tightening of financial conditions, which tends to push all other interest rates, including the 10-year, higher. The Fed's communication, their speeches, their press conferences, their economic projections, can cause huge swings in the bond market as traders try to get ahead of their next move. Third is the health of the economy. When the economy is strong, unemployment is low, and companies are posting record profits, investors feel more confident. They're more willing to sell their safe Treasury bonds and buy riskier assets like stocks that offer the potential for a much higher return. This selling pressure pushes bond prices down and yields up. Conversely, when there are signs of a recession, investors get scared. They sell stocks and rush back to the safety of treasuries, pushing prices up and yields down. And finally, there's global uncertainty, often called a flight to safety. The U.S. Treasury market is the world's ultimate safe harbor. When a major geopolitical crisis erupts, when a foreign bank looks like it might collapse, or when a global pandemic shuts down the world, international capital floods into U.S. bonds. Everyone is seeking the security of the U.S. government's guarantee. This massive wave of buying pushes bond prices way up and causes yields to plummet. This is why you sometimes see the strange phenomenon of bad global news actually causing U.S. mortgage rates to fall. So, when you see that 10-year Treasury yield number flash across the news, you can now see it for what it truly is. It's not just a random number for Wall Street. It's a complex, living indicator. It's a real-time gauge of the market's collective belief about the future of inflation, the actions of the Federal Reserve, the strength of the economy, and the stability of the entire world. It is the bedrock upon which your mortgage rate is built. We've established the 10-year Treasury as the sun in our financial solar system, dictating the orbit of mortgage rates. But what force governs the sun itself? Of all the drivers we just mentioned, one stands above the rest. It's the single economic data point that causes more panic, more celebration, and more violent movement in the Treasury market than any other. It is the #1 enemy of your purchasing power and the primary nemesis of a low mortgage rate. We need to understand it inside and out. And that is the beast we will dissect next. Inflation. So let's dissect this beast. At its core, inflation is simple. It's the silent thief that sneaks into your wallet every single night and steals a little bit of your purchasing power. Remember when a gallon of milk cost $2? Or when you could fill up your gas tank for $20? That's inflation at work. It's the reason that the dollar your grandfather saved under his mattress in 1980 is worth a fraction of that today. In economic terms, it's the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Your money simply buys less than it used to. Now, who is tasked with fighting this beast? In the United States, that responsibility falls squarely on the shoulders of the Federal Reserve, often just called the Federal. Think of the Fed as the high council of the U.S. economy. They have a mission, a dual mandate given to them by Congress, to promote maximum employment and to maintain stable prices. Notice the inherent conflict there. Maximum employment and stable prices. These two goals are often at odds. Pushing for maximum employment can sometimes heat up the economy and cause prices to rise. Fighting to keep prices stable can sometimes mean cooling the economy down, which can cost people their jobs. It's a constant, high-stakes balancing act, and they walk this tightrope every single day. So what is the Fed's primary weapon in this fight against inflation? It's an interest rate you've probably heard of, but might not fully understand: the federal funds rate. This is not the rate you get on your mortgage. It's not the rate you get on your car loan. The federal funds rate is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. Why on earth should you care about the rate banks charge each other for a one-night loan? Because it's the bedrock. It's the foundation upon which almost all other short-term interest rates in the U.S. are built. When the Fed raises or lowers the federal funds rate, it creates a ripple effect. That change almost immediately influences the prime rate, which is the rate banks offer to their most creditworthy customers. And the prime rate directly impacts what you pay on your credit cards, your home equity lines of credit, and your auto loans. So let's connect the dots. When inflation is running hot, when prices for everything from groceries to rent are climbing too fast, the Fed steps in. They announce they are raising the federal funds rate. They are deliberately making it more expensive for banks to borrow money. This, in turn, makes it more expensive for businesses to borrow money for new factories or equipment, and it makes it more expensive for you to borrow money for a new car or a home renovation. The goal is to tap the brakes on the entire economy. By making borrowing more expensive, the Fed reduces the overall demand for goods and services. When people and businesses stop spending so freely, the upward pressure on prices starts to ease. Companies can no longer just pass on higher costs to consumers, because consumers are tightening their belts. This is how the Fed cools down an overheating economy and brings inflation back under control. Now, this is where the connection to mortgage rates becomes crystal clear, even though it's an indirect one. While the Fed's actions don't directly set the 30-year fixed mortgage rate, their fight against inflation is the main event. When the Fed raises rates, they are sending a powerful signal to the entire financial world. We are serious about fighting inflation. Bond investors hear this loud and clear. Remember our friends in the Treasury market? They see the Fed tightening its grip, and they anticipate the economy will slow down. They also demand a higher yield on their long-term investments, like the 10-year Treasury bond, to protect themselves from the very inflation the Fed is fighting. And as we established, where the 10-year Treasury goes, mortgage rates almost always follow. A hawkish, inflation-fighting Fed almost always means higher mortgage rates. The great fear, the tightrope I mentioned, is that the Fed might tap the brakes too hard. If they raise rates too aggressively, they can slow the economy down so much that it tips into a recession. That's the dreaded hard landing. Businesses lay off workers, unemployment rises, and the country faces a period of economic pain. The Fed's dream scenario is a soft landing, where they manage to bring inflation down to their target, which is typically around 2%, without causing a major recession. This is incredibly difficult to achieve, and the uncertainty around whether they can pull it off is what causes so much volatility in the markets. So, if the Fed's decisions are based on inflation, how do they even measure it? They don't just look out the window and see that gas prices are up. They rely on a few key economic reports, and these reports have become the most watched, most scrutinized, and most market-moving pieces of data released each month. The first and most famous is the CPI, the Consumer Price Index. The CPI is released by the Bureau of Labor Statistics, and it measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Think of it as the nation's monthly shopping receipt. It includes everything from housing costs, food, and apparel to transportation, medical care, and education. When you hear on the news that inflation came in at 3.5%, they are almost always talking about the year-over-year change in the CPI. But while the CPI gets all the headlines, it's not actually the Fed's favorite inflation gauge. The Fed prefers a different report called the PCE, or the Personal Consumption Expenditures Price Index. Why? The PCE is considered broader and more comprehensive. Crucially, it accounts for something called the substitution effect. For example, if the price of beef skyrockets, the CPI basket just registers that beef is more expensive. The PCE model, however, recognizes that when beef gets too pricey, many consumers will switch to chicken. It adjusts for this change in behavior, which the Fed believes gives a more accurate, real-world picture of how price increases are actually affecting people's spending. Furthermore, the Fed pays even closer attention to something called core PCE. Core PCE takes the regular PCE data and strips out the two most volatile components: food and energy prices. Gas prices can swing wildly based on global events that have nothing to do with the underlying health of the U.S. economy. By looking at the core number, the Fed tries to get a clearer signal of the long-term inflation trend, free from the noise of short-term price shocks. So here is the final critical link for anyone watching mortgage rates. Every month, on the day these CPI and PCE reports are released, the entire financial world holds its breath. If the inflation numbers come in hotter than expected, meaning prices are rising faster than economists predicted, it's bad news for mortgage rates. The bond market immediately sells off. Why? Because investors assume the Fed will have to be more aggressive, raising rates higher or keeping them high for longer to stomp out the stubborn inflation. The 10-year Treasury yield spikes, and mortgage lenders reprice their rates higher, sometimes within minutes of the report's release. Conversely, if the inflation report comes in cooler than expected, the market breathes a collective sigh of relief. This is good news for mortgage rates. Investors see it as a sign that the Fed's plan is working, and that they might be able to ease up on their rate hikes, or even start cutting rates sooner than anticipated. The 10-year Treasury yield falls, and mortgage rates tend to follow it down. Inflation, and the Federal Reserve's reaction to it, is the heavyweight champion of mortgage rate drivers. It is the central drama, the main plot line that every homebuyer, homeowner, and real estate professional must follow. But inflation is only one half of the Fed's dual mandate. There's another, equally powerful economic force they are tasked with managing, a force that directly impacts the financial health of every single American household. It's the number that tells us if the economy is creating or destroying livelihoods, and its monthly report can send shockwaves through the system just as violently as any inflation reading. That force is the U.S. jobs market. Every first Friday of the month, at precisely 8:30 a.m. Eastern Time, the financial world stops. Trillions of dollars hang in the balance, waiting for a single government report. This isn't just data. It's a verdict on the American dream. And the reason it holds so much power is because it speaks directly to the Federal Reserve's other, equally critical mission. You see, the Fed isn't just an inflation-fighting dragon. It lives by a dual mandate, a sworn oath to Congress to pursue two goals: stable prices, which we've covered, and maximum employment. Think of it as a tightrope walker high above a canyon. In one hand, they hold a balancing pole labeled inflation. In the other, a pole labeled jobs. If they lean too far to one side, fighting inflation too aggressively, they risk tipping the economy into a recession, costing millions of people their jobs. But if they lean too far the other way, letting the job market run too hot, they risk stoking the very inflation they're supposed to control. Every decision they make is a delicate, terrifying rebalancing act. And the monthly jobs report is the gust of wind that can throw them off balance in an instant. The official name is the Non-Farm Payrolls Report, or NFP. It's the heavyweight champion of economic indicators. It tells us three vital things. First, the headline number: how many jobs the U.S. economy added or lost in the previous month. Second, the unemployment rate, the percentage of the labor force that is jobless but actively seeking work. And third, perhaps the most crucial for our purposes, average hourly earnings, the rate at which wages are growing. Together, these three data points paint a vivid picture of the economy's health, and the Fed watches this picture like a hawk. Let's play out a scenario. Imagine it's the first Friday of the month. The report drops and it's a blockbuster. The economy added way more jobs than anyone expected. The unemployment rate fell to a historic low, and wages are surging. On the surface, this is fantastic news, right? It's a sign of a booming, prosperous nation. The media celebrates it. Politicians take a victory lap. But inside the marble halls of the Federal Reserve, a siren is blaring. Why? Because a hot jobs report is pure inflationary fuel. When everyone has a job and wages are rising fast, people have more money to spend. They feel confident, secure. They buy new cars, they renovate their kitchens, they go on vacation. This surge in consumer spending creates massive demand for goods and services. Businesses can't keep up. They see people willing to pay more, so they raise prices. At the same time, to attract the few available workers, they have to offer higher and higher wages, and they pass those extra labor costs on to you, the consumer, in the form of, you guessed it, higher prices. It's the dreaded wage price spiral, the very feedback loop that can make inflation a chronic runaway disease. The Fed sees this and knows it has to act. The jobs side of their balancing act is looking strong, but the inflation side is teetering dangerously. They have to cool the economy down. Their primary tool to do this is raising the federal funds rate. By making it more expensive for banks to borrow money, they create a ripple effect that makes all forms of borrowing more expensive, from credit cards to business loans. The bond market, which is always trying to skate to where the puck is going, immediately reacts. Investors sell off bonds, anticipating higher rates from the Fed, which causes bond prices to fall and their yields to soar. And as we now know, the 10-year Treasury yield is the North Star for mortgage rates. Lenders see the yield on this super safe investment going up, so they have to demand a higher rate on a riskier 30-year mortgage to make it worthwhile. So, in a strange and counterintuitive twist, a great jobs report is terrible news for mortgage rates. The day that good economic news flashes across the screen is the day you'll likely see mortgage rates jump. Now let's flip the coin. Imagine it's 8:30 a.m. on that first Friday, and the report is a dud. Job growth is flat, or worse, the economy actually lost jobs. The unemployment rate ticks up. Wage growth stalls. The headlines are grim. Talk of layoffs and recession fills the air. This is undeniably bad news for the country, and for the workers directly affected. But for the Fed, the alarm that was screaming about inflation suddenly goes silent. A new, more urgent alarm starts ringing. The one for maximum employment. In this scenario, the Fed's priority shifts dramatically. The threat is no longer an overheating economy. It's a contracting one. People are losing jobs, they're scared, and they're pulling back on spending. This lack of demand is a powerful disinflationary force. Businesses can no longer raise prices. They might even have to cut them to attract nervous customers. The inflation dragon is retreating back into its cave. Now the Fed's job is to prevent the economy from sliding into a full-blown recession. They need to make money cheaper to encourage businesses to invest and consumers to spend. So they do the opposite. They signal that they're going to cut the federal funds rate. The bond market, ever forward-looking, springs into action. Investors, anticipating lower rates, pile into bonds, buying them up before their yields fall. This buying frenzy pushes bond prices up and their yields down. The 10-year Treasury yield plummets. Mortgage lenders, seeing their own cost of funds about to get cheaper and seeing inflation as a distant memory, can now offer much more attractive rates to entice people to borrow and buy homes. And just like that, a terrible jobs report becomes fantastic news for mortgage rates. The day the bad economic news hits is the day you could see mortgage rates take a significant dip. Of course, the real world is rarely so black and white. What the Fed, the markets, and frankly, what everyone really wants is the Goldilocks scenario. Not too hot, not too cold. This would be a report showing moderate job growth. Enough to keep up with population growth, but not enough to cause a labor shortage. It would show wage growth that's solid but not explosive, ideally rising just a bit faster than inflation so people are actually getting ahead. This kind of report suggests the economy is in a state of equilibrium. It allows the Fed to just sit back and watch. No need to raise rates, no need to cut them. This stability is reassuring to the bond market, leading to less volatility and potentially a slow, steady, predictable path for mortgage rates. But the true professionals, the ones whose trades move markets, know that the headline numbers are just the beginning of the story. They dig deeper into the report's guts. They look obsessively at average hourly earnings. If 300,000 jobs were created but wages didn't budge, the Fed might just shrug. But if only 100,000 jobs were created and wages shot up by a full percent, the inflation alarm goes off. That wage number is a direct look into the inflationary pipeline. They also scrutinize the labor force participation rate. A low unemployment rate is less impressive if millions of people have simply given up looking for work. A rising participation rate, however, is a sign of a truly healthy and confident workforce. Finally, they always watch the revisions. The first report is just an estimate. Over the next 2 months, it gets revised as more data comes in. Sometimes a hot report can be revised away into nothing, and a weak report can be revised into a blockbuster, completely changing the economic narrative after the fact. So when you hear about the jobs report, don't just see it as a number. See it for what it is: a monthly referendum on the Fed's tightrope walk. It's a complex signal that can instantly change the cost of the single biggest purchase you will ever make. It dictates whether the winds are at your back or in your face as a homebuyer. We've now examined the price of goods through inflation and the price of labor through the jobs market. But there's one more critical human element we have to understand. It's the engine that drives over 2/3 of the entire US economy. It's not about data or statistics, but about something far more primal: feelings. The collective mood, confidence, and willingness to spend of the American consumer. And that feeling, that collective economic mood, is so critical that economists have spent decades trying to bottle it, to measure it, to turn a feeling into a number. They've largely succeeded, and the two most important numbers you'll hear about are the Consumer Confidence Index, or CCI, and the University of Michigan's Consumer Sentiment Index. Now, don't let the names intimidate you. They're just fancy terms for a national-level vibe check. Think of it like this. Every month, researchers call up thousands of American households. They don't ask complex economic questions. They ask about feelings. They ask, how are you feeling about your own finances right now? Do you think you'll be better or worse off in 6 months? Do you think now is a good time to make a major purchase like a car, an appliance, or a house? And crucially, they ask, what do you expect inflation to be in the next year? They take all these answers, all this hope and fear and anxiety, and they distill it into a single number. That number tells us a story. It's a snapshot of the American consumer's psyche. When the number is high, it means people are optimistic. They feel secure in their jobs, they see their incomes rising, and they're ready to open their wallets. When the number is low, it means the opposite. People are worried. They're seeing layoffs in the news, they feel the pinch of high prices at the grocery store, and they're starting to stash their cash away for a rainy day. So, why on earth does the Federal Reserve, a group of stoic economists, care so deeply about a number based on feelings? Because those feelings are the single best predictor of future spending. And future spending is the single biggest driver of future inflation. It's a direct, almost primal chain reaction. Let's walk through it. Imagine consumer confidence is surging. The reports come out, and the numbers are climbing month after month. What does this signal to the Fed? It signals that millions of people are about to go out and spend money. They're going to book that vacation to Hawaii. They're going to finally replace that 10-year-old dishwasher. They're going to start seriously browsing Zillow and calling real estate agents. This creates a massive wave of demand crashing into the economy. But the supply of goods and services, the number of hotel rooms in Hawaii, the number of dishwashers on the factory floor, the number of houses for sale, can't increase overnight. And what happens when huge demand chases limited supply? Prices go up. That is the very essence of demand pull inflation. The Fed sees high consumer confidence today as a giant, flashing billboard that says inflation ahead. And what is the Fed's one and only tool to fight inflation? The hammer of interest rates. When they see that confidence number ticking up, they start to think about tapping the brakes on the economy. They raise the federal funds rate, which makes it more expensive for banks to borrow money. The banks in turn pass that cost on to you. Credit card rates go up. Car loan rates go up. And yes, the cost to originate a mortgage goes up. They are deliberately making it more painful to borrow money to get people to stop spending so much, to let supply catch its breath, and to bring inflation back down. But there's a second, more direct effect on mortgages. When everyone is confident and feels like it's a great time to buy a house, what happens? More people jump into the housing market. This creates a surge in demand not just for houses but for the loans to buy them, for mortgages. Lenders see this line of eager buyers forming at their door, and they do what any business would do. They raise the price of their product. And the price of a mortgage is its interest rate. So high consumer confidence can hit you with a double whammy. It pushes the Fed to raise rates generally, and it increases competition for mortgages specifically, both of which send your potential mortgage rate higher. Now let's flip the coin. What happens when consumer confidence plummets? Imagine a period of uncertainty. Maybe there are major corporate layoff announcements. Maybe gas prices are spiking. The monthly confidence reports come out, and the numbers are ugly. People are scared. This fear signals to the Fed that a spending slowdown is coming. People are going to cancel that vacation. They're going to try and get another year out of that old dishwasher. And they're certainly going to put their house hunting plans on hold. They're going to start saving, not spending. This pullback in spending acts as a natural coolant for the economy. Demand for goods and services drops, which eases the pressure on prices. Inflation starts to fall. The Fed sees this and breathes a sigh of relief. The threat of an overheating economy is fading. They might decide to hold rates steady, or if the confidence numbers get bad enough and they start to fear a recession, they might even consider cutting interest rates to encourage spending and stimulate the economy. This, in turn, would lead to lower mortgage rates. At the same time, with fewer people shopping for homes, there's less demand for mortgages. Lenders now have to compete for a smaller pool of customers, often by offering more attractive, lower interest rates. We don't need to look at a textbook for this. We just lived through the most dramatic example in a generation. Think back to late 2020 and 2021. People were cooped up, but they had government stimulus checks and a year's worth of saved-up vacation money. The moment things started to open up, an explosion of pent-up demand was unleashed. Consumer spending went through the roof. People bought everything in sight, from patio furniture to pickup trucks. And this spending frenzy, combined with broken supply chains, lit a bonfire under inflation. The Fed saw this consumer-driven inferno and responded with the fastest series of interest rate hikes in 40 years. And mortgage rates, as we all painfully remember, skyrocketed from under 3% to over 7% in what felt like the blink of an eye. That entire episode was a masterclass in the power of consumer sentiment. So when you see a headline that says, "Consumer confidence surprises to the upside," you shouldn't just see it as good news. You should see it through the eyes of a mortgage rate analyst. You should think, okay, people are feeling good. That means they're likely to spend more. That increases the risk of inflation. That puts pressure on the Fed to keep rates higher for longer. And that, ultimately, means the mortgage rate I get quoted next month might be a little bit higher. Conversely, if you see a headline that says, "Consumer sentiment tumbles amid recession fears," your first thought might be concern. But your second thought as a rate watcher should be, okay, people are pulling back. That means less spending. That reduces the risk of inflation. That gives the Fed more room to potentially cut rates in the future. The mortgage rate forecast just tilted, ever so slightly, in a downward direction. This single indicator, this measure of feelings, acts as a powerful forecast of its own. It's the voice of the American household telling us where the economy is headed. It's the demand side of the great economic equation. But what about the other side? What about the businesses, the factories, the corporations that actually make all the stuff we're so busy buying or not buying? What story are they telling? Because when the story from the consumer and the story from the producer start to diverge, that's when things get really interesting. So let's peek behind the curtain. Let's look at the engine room of the economy. If the consumer is the passenger on the ship, the producers are the crew shoveling coal into the furnace. And their most important report card is the Producer Price Index, or PPI. Think of it this way. If the CPI is the price you pay for a burger at a restaurant, the PPI is what the restaurant paid for the ground beef, the buns, and the lettuce. It's a measure of inflation at the wholesale level, before the product ever gets to the store shelf. And this is why the Federal Reserve watches it like a hawk. The PPI is a crystal ball for the CPI. If the price of ground beef, buns, and lettuce goes up for the restaurant this month, it's almost a mathematical certainty that the price of your burger is going up next month. The restaurant owner isn't just going to absorb that cost forever. So when the Fed sees a hot PPI report, alarm bells start ringing. It's a signal that more consumer inflation is already in the pipeline, baked into the supply chain. A high PPI reading tells the Fed, "Don't you dare think about cutting rates because another wave of price hikes is coming." Conversely, if the PPI starts to fall, it's one of the first and most powerful signals that the inflationary fever is breaking, giving the Fed the green light they desperately need to consider easing up and letting mortgage rates come down. PPI is the preview. CPI is the main event. But the PPI only tells us about prices. It doesn't tell us how busy the producers are. Are they running their factories 24/7? Or are they laying people off and shutting down production lines? For that, we turn to one of the most powerful real-time indicators in all of economics, the Purchasing Managers' Index, or PMI. Now, this one sounds complicated, but the idea is pure genius. Instead of waiting for months to get official government data, a group called the Institute for Supply Management, or ISM, simply calls up hundreds of purchasing managers across the country every single month. These are the people on the front lines. They're the ones ordering the raw materials, the parts, the software, everything a company needs to operate. They know better than anyone if business is booming or busting. The survey asks them simple questions. Is your new order volume higher or lower than last month? Is your production increasing or decreasing? Are you hiring or firing? Are your suppliers delivering faster or slower? It's a direct pulse check on the veins of the economy. And here's the magic. They take all these answers and boil them down into a single number. And the only thing you need to remember is the number 50. 50 is the line in the sand. If the PMI number is above 50, it means the manufacturing or services sector is expanding. More orders, more production, more hiring. The engine is revving. If the number is below 50, it means the sector is contracting. Fewer orders, less production, potential layoffs. The engine is sputtering. A reading of 55 is a solid expansion. A reading of 60 is a sign of a red-hot economy. A reading of 45 means a significant contraction. And a reading down near 40? That's typically a sign of a full-blown recession. The Fed is obsessed with this number. Why? Because it's forward-looking. It's not telling us what happened 2 months ago. It's telling us what is happening right now and what is likely to happen next month. If the Fed sees a PMI reading of, say, 58, they know the economy is running strong. This gives them confidence that the economy can handle higher interest rates. It tells them, we can keep our foot on the brake to fight inflation without crashing the car. A strong PMI is bearish for mortgage rates because it empowers the Fed to stay hawkish. But what if the PMI number comes in at 47, and then the next month it's 46? That is a massive red flag. That tells the Fed that their high interest rates are starting to bite. Businesses are pulling back. A recession is becoming a real threat. In that scenario, the Fed's entire calculation changes. The pressure to cut rates, to stimulate the economy and prevent a major downturn, becomes immense. A weak PMI is the market's best friend when it's hoping for lower mortgage rates. We also have to look at the two different PMIs. One for manufacturing, the companies that make physical things, and one for services, which covers everything from software companies and hospitals to restaurants and banks. Sometimes they tell different stories. We might see a manufacturing PMI below 50, indicating a slump in goods production, while the services PMI is humming along at 56. This paints a picture of a complex two-track economy, where people are spending less on stuff but more on experiences, travel, and digital services. This nuance is critical for the Fed's decision-making. So we have producer prices from the PPI and business activity from the PMI. But there's another indicator that speaks volumes about corporate confidence: durable goods orders. Durable goods are expensive items that are meant to last 3 years or more. We're not talking about paper clips and coffee filters. We're talking about airplanes, industrial machinery, computer systems, cars, and washing machines. When a company like Boeing gets a massive order for new 737s, or when a factory invests in a new multi-million-dollar robotic assembly line, that gets counted in the durable goods report. This is a measure of big bets on the future. A company doesn't spend $100 million on new equipment unless it's confident that demand will be strong for years to come. So, a strong durable goods report is a powerful sign of economic optimism and future investment. It tells the Fed that businesses are healthy and willing to spend, suggesting the economy can withstand higher rates. On the flip side, if durable goods orders start to plummet, it's a sign of deep-seated fear. Businesses are slamming the brakes on big projects. They're hunkering down, expecting a storm. This is a 5-alarm fire for the Federal. It's a signal that the economy is losing its long-term growth engine, and it adds tremendous pressure on them to cut rates to try and restore that business confidence. Finally, while PMI and durable goods are about sentiment and future plans, we need a reality check. Are the factories actually producing more stuff? For that, we have the Industrial Production Index. This is a hard data point. It measures the real physical output of the nation's factories, mines, and utilities. It tells us, in concrete terms, if we are making more or less stuff than we did last month or last year. If PMI is what purchasing managers think is going to happen, industrial production is what actually happened. When a strong, optimistic PMI report is followed by a strong industrial production report, it confirms that the economy is truly firing on all cylinders. This gives the Fed maximum confidence to keep rates high. But if you see a weak industrial production number, it shows that the gears of the economy are physically grinding slower, regardless of what any survey says. It's hard evidence of a slowdown that the Fed simply cannot ignore. So you see, the story told by the producers is just as important as the story told by the consumers. By watching the flow of costs with the PPI, gauging the real-time pulse with the PMI, measuring long-term bets with durable goods, and confirming it all with the hard output of industrial production, we get a complete picture of the corporate side of the economy. This is the data that tells the Fed whether the economic engine is overheating or about to stall. But there's one final crucial piece of this puzzle, one that connects both the consumer and the producer. It's the lifeblood of the entire system. It's the one indicator that can single-handedly dictate Federal Reserve policy, and in turn, the future of your mortgage rate: the U.S. labor market. Think of the U.S. economy as a complex human body. If inflation is the fever, and consumer spending is the circulatory system, then the labor market is the heart. It's the powerful rhythmic engine that pumps life-sustaining income to every corner of the nation. When the heart is strong and steady, the body thrives. But if it beats too fast, it overheats the entire system. If it starts to weaken, everything begins to shut down. This is why the Federal Reserve watches the labor market with the intensity of a cardiac surgeon during open heart surgery. And their diagnosis, their every move directly impacts the cost of your home loan. The monthly checkup for this economic heart is the Employment Situation Summary, but everyone on Wall Street just calls it the Jobs Report. On the first Friday of every month at exactly 8:30 a.m. Eastern Time, the Bureau of Labor Statistics releases this data, and for a few minutes the entire financial world holds its breath. The headline number that grabs all the attention is non-farm payrolls, or NFP. This is simply the net number of jobs created or lost in the previous month, excluding farm workers, private household employees, and non-profit workers. It's the economy's monthly report card. A big positive number, say 300,000 jobs added, is like getting straight A's. It tells the Fed that businesses are confident. They're expanding, they're hiring, and they're investing. It means hundreds of thousands of people now have a steady paycheck. They're going to go out and buy groceries, cars, and yes, houses. This sounds fantastic, right? But to the Fed, a report that's too good can be a red flag. It's a sign of a roaring economy, an engine running hot, which pours fuel on the fire of inflation. When they see a string of blockbuster jobs reports, their hands start inching towards the interest rate lever, ready to hike rates to cool things down before they spiral out of control. Conversely, a weak number, or worse, a negative one, is a failing grade. It signals that businesses are scared. They're pulling back, laying people off. This means less spending, lower demand, and a slowing economy. It's a powerful deflationary force. When the Fed sees the job market faltering, its primary concern shifts from fighting inflation to preventing a recession. In this scenario, they're far more likely to pause rate hikes, or even start cutting rates to try and jumpstart the economic heart. This, in turn, puts downward pressure on mortgage rates. Alongside the NFP number is its famous sibling, the unemployment rate. This is the percentage of the labor force that is jobless but actively looking for work. A low unemployment rate is a sign of a tight labor market. Imagine a small town with 100 available workers and 99 open jobs. Every worker has their pick of opportunities. This is great for the worker, but for the economy as a whole, it creates a massive problem. And it's this problem that keeps Fed officials awake at night. Because when companies are fighting over a small pool of available workers, they have to do one thing to compete: pay more. And this brings us to the most critical piece of the labor puzzle, the one that connects the jobs report directly to the price of a gallon of milk and the interest rate on your 30-year fixed mortgage: wages. Buried inside the jobs report is a number called average hourly earnings. This tracks the change in how much we're all getting paid. And when this number starts to rise quickly, it can trigger the Fed's single greatest fear: the dreaded wage price spiral. It's a vicious cycle, and it works like this. Let's go back to our town with a tight labor market. The local factory needs to hire 5 people but can't find anyone. So they raise their starting wage by $2 an hour to lure workers from the coffee shop down the street. Now, to keep its own employees, the coffee shop has to match that wage increase. Suddenly, the labor costs for both businesses have shot up. To protect their profits, what do? The factory raises the price of the widgets it sells, and the coffee shop raises the price of a latte. Now, you, the worker, are making more money, but you notice your morning coffee and everything else is more expensive. Your raise has been eaten up by inflation. So what do? You go back to your boss and demand another raise to keep up with the rising cost of living. This forces the businesses to raise prices again, and again, and again. That is a wage price spiral. It's inflation that feeds on itself, becoming entrenched in the economy and incredibly difficult to stop without causing serious economic pain. When the Fed sees strong job growth combined with rapidly rising wages, they see this spiral taking hold. They know they have to act decisively. Their only real tool to break the cycle is to make money more expensive by raising interest rates. They do this to deliberately slow the economy down, to cool off business demand for new workers, and to break the fever of wage growth. And as the Fed raises its key interest rate, lenders immediately pass that cost on. The rate on car loans goes up, credit card APRs go up, and mortgage rates soar. Your potential mortgage payment is a direct casualty in the Fed's war against the wage price spiral. But the Fed doesn't just look at 1 month's report. They look for trends, and they supplement the main jobs report with other, more frequent data to get a real-time feel for the labor market's health. Two of these are absolutely crucial. The first is the JOLTS report, which stands for Job Openings and Labor Turnover Survey. Think of this as the help wanted sign for the entire U.S. economy. It measures how many jobs are currently unfilled. If there are millions more job openings than there are unemployed people to fill them, it tells the Fed the labor market is still incredibly tight, and the risk of wage inflation is high. But when the number of job openings starts to fall, it's an early warning sign that businesses are getting nervous and are pulling back on hiring, even before they start laying people off. The second is even more immediate: the weekly initial jobless claims. This is the number of people filing for unemployment benefits for the very first time. It comes out every single Thursday morning. While the big jobs report is a monthly snapshot, jobless claims are like taking the economy's pulse every single week. If that number stays low, it means people aren't losing their jobs and the market is stable. But a sudden sustained spike in weekly claims can be the canary in the coal mine. The first concrete sign that layoffs are starting and the labor market is beginning to crack. Bond traders and the Fed watch this number religiously. A surprise jump can send bond yields and mortgage rates tumbling in a matter of hours. So when you hear the news talking about job creation, unemployment, and wages, understand that they're not just abstract economic statistics. They are telling a deeply human story. It's the story of whether your neighbor can find a new job, whether your company is hiring or firing, and whether you have the confidence and the income to buy a home. The Federal Reserve is reading this story, page by page, week by week. And the plot of that story, whether it's a tale of booming prosperity or one of looming struggle, is what they use to write the next chapter for the U.S. economy and for the interest rate on your mortgage. But while the Fed and its reading of the labor market sets the overall tone for interest rates, they don't actually post the daily mortgage rates you see online. The price tag on your loan is set by a completely different group of people, operating in a different arena. They aren't economists in Washington, D.C. They are traders on Wall Street. And their world, the one that directly translates all this economic data into your monthly payment, is the U.S. bond market. The U.S. bond market. It sounds intimidating, maybe even a little boring. But I promise you, this is where the magic and the misery of your mortgage rate actually happens. Forget the Fed's meeting room for a second. Picture the world's largest, most high-stakes auction, happening every single second of every trading day. What's being bought and sold? Debt. Specifically, U.S. government debt. Let's break it down to its simplest form. What is a bond? It's just an IO. When you buy a U.S. Treasury bond, you are lending money to the U.S. government. In return, the government promises to pay you back in full on a specific date, and along the way it pays you interest. The interest you earn as a percentage of the price you paid is called the yield. That word yield is everything. Burn it into your brain. Now, there are many different types of these bonds, like different lengths of loans. You have short-term bonds and long-term bonds. For the world of mortgages, the undisputed king, the North Star that everything else revolves around, is the 10-year Treasury note. Why? Because a 30-year mortgage is a long-term loan, and the 10-year Treasury is the global benchmark for long-term lending. It's considered the safest investment on planet Earth because it's backed by the full faith and credit of the United States government. Its yield is often called the risk-free rate. So, how does this giant auction for 10-year Treasury notes affect your mortgage? It comes down to one of the most fundamental and initially confusing relationships in all of finance: the inverse relationship between a bond's price and its yield. Think of it like a seesaw. On one end, you have the price of the bond. On the other end, you have its yield. When the price of the bond goes up, the yield goes down. When the price of the bond goes down, the yield goes up. They always move in opposite directions. Why? Let's say the government issues a bond for $1,000 that pays $40 of interest per year. That's a 4% yield. Simple enough. But these bonds are traded on the open market. If economic news suddenly gets scary, say a really bad jobs report comes out, investors get nervous. They pull their money out of the risky stock market and rush to buy the safest thing they can find: U.S. Treasury bonds. This huge surge in demand drives the price of that $1,000 bond up to, say, $1,100. But the government is still only paying that same $40 of interest per year. $40 on an $1,100 investment is no longer a 4% yield. It's now only a 3.6% yield. The price went up and the yield went down. The opposite is also true. If a report shows inflation is running red hot, investors get spooked. That fixed $40 year payment looks less attractive when the cost of everything is soaring. They start selling their bonds. This flood of supply pushes the price down to, say, $900. But it still pays $40 a year. Now, $40 on a $900 investment is a 4.4% yield. The price went down and the yield went up. This is the seesaw in action. And mortgage rates tend to ride along on the yield side of that seesaw. When the 10-year Treasury yield goes up, mortgage rates tend to follow. When it goes down, mortgage rates tend to follow. They don't move in perfect lockstep, but the 10-year yield sets the general direction. It's the current in the river that mortgage rates are floating on. But if we want to get even more precise, and you've come this far, so let's get precise, we need to look at another, more specific corner of the bond market. This is the instrument that is directly tied to your mortgage payment. It's called a mortgage-backed security, or MBS. The name sounds complex, but the concept is straightforward. A lender like a bank doesn't just hold on to your 30-year mortgage. That's a lot of cash to have tied up for 3 decades. Instead, they bundle your mortgage together with thousands of other similar mortgages. Then they sell this giant bundle as a single investment, a security, to traders on Wall Street. The investors who buy this MBS are essentially buying the right to collect all the monthly principal and interest payments from all those homeowners. The interest rate paid by that MBS is what directly determines the mortgage rate the lender can offer you tomorrow. And just like a treasury bond, these MBS have a price and a yield that operate on that same seesaw. Now, an investor buying an MBS knows it's not as safe as a U.S. Treasury bond. Homeowners can default, or they might refinance or sell their home, paying off the loan early, which cuts off that future stream of interest payments for the investor. Because of this extra risk, investors demand a higher yield on an MBS than they would on a 10-year Treasury. This extra bit of yield is called the spread. So, your mortgage rate is essentially the 10-year Treasury yield, plus this MBS spread. And this is where it all comes together. Every single piece of economic data we've talked about, the CPI inflation report, the jobs number, the retail sales figures, the Fed's announcements, all of it is being watched in real time by millions of bond traders around the world. These traders aren't waiting for a committee to meet. They are placing bets instantly with billions of dollars. When the CPI report comes in hotter than expected, what do? They sell bonds. They fear inflation will eat away at their fixed interest payments. They sell both treasuries and MBS. Prices plummet. Yields skyrocket. The spread might even widen as fear increases. And within minutes, the cost for lenders to create new mortgages goes up, and the rates you see online tick higher. When a jobs report comes in shockingly weak, signaling a potential recession, what happens? Those same traders dump their stocks and stampede into the safety of bonds. They buy treasuries and MBS, driving their prices up. The seesaw tips. Yields fall. And mortgage rates begin to drift down. This market isn't a person. It's a collective consciousness. It's a global digital nervous system reacting to every headline, every data point, every whisper of geopolitical tension. It's the ultimate voting machine for the economy's future, where every vote is $1, and the results are tallied every second. While the Federal Reserve sets the tone and tries to conduct the orchestra, it's the bond market, this chaotic, emotional, forward-looking beast of fear and greed, that is actually playing the music. And the final note of that music is the interest rate you pay on the biggest purchase of your life. So if the bond market is the musician, the next logical question is, how do we learn to read the sheet music? How can you, an aspiring homeowner or a refinancer, get a glimpse into the mind of this massive global financial consciousness? The answer is you learn to watch what it watches. You build the same dashboard of critical gauges that every bond trader from Wall Street to London to Tokyo has on their screens. And while there are dozens of data points, it really boils down to 3 primary dials that tell you almost everything you need to know about the direction of the economy, and therefore the direction of your mortgage rate. The first, and by far the most important gauge, is inflation. We've touched on this, but it's impossible to overstate its importance. Inflation is the arch nemesis of the bond market. It is the kryptonite to a bond investor's portfolio. Why? Because a bond is essentially a promise of fixed payments over a long period. If you buy a 10-year Treasury bond, you are locking in a specific interest payment or coupon for a decade. But if inflation suddenly surges, the value, the actual purchasing power, of those future payments gets decimated. That fixed 2 or 3% return that looked great in a low inflation world suddenly becomes a net loss when inflation is running at 5%. Inflation is a wealth-destroying acid that dissolves the very foundation of a bond's value proposition. This is why the monthly release of the Consumer Price Index, or CPI, is one of the most anticipated market-moving events. It's the official report card on inflation. When that number comes out hotter than expected, you can almost feel a collective gasp across financial markets. It's a signal that the acid is spreading faster than anticipated. Bond traders in a panic start dumping their bonds. Why? Because they know two things are about to happen. First, the real return on their existing bonds is now lower. Second, and more importantly, they know the Federal Reserve is watching. A hot inflation report is a direct challenge to the Fed's mandate of price stability. It's like waving a red flag in front of a bull. The market immediately begins to price in a more aggressive Fed. Higher interest rates for longer. So bond prices plummet, which, as we know, means yields, and the mortgage rates tied to them skyrocket. The opposite is also true. A CPI report that comes in cooler than expected is a cause for celebration in the bond market. It's a sign the inflation beast is being tamed, giving the Fed room to breathe, and maybe even consider cutting rates down the road. Bond prices rally, yields fall, and mortgage rates get a welcome dose of relief. So rule number 1 for your dashboard: watch inflation like a hawk. It is the primary driver. The second critical gauge on your dashboard is the labor market, specifically the monthly jobs report, officially known as the Employment Situation Summary. Think of the labor market as the engine of the U.S. economy. When the engine is running hot, meaning lots of jobs are being created and unemployment is low, it's generally a good thing for the country. But for the bond market, it's a flashing yellow warning light. A super strong job market means more people have paychecks. More paychecks mean more consumer spending. And a tsunami of consumer spending can push prices up, creating, you guessed it, inflation. Furthermore, a tight labor market, where businesses are competing for a limited pool of workers, forces them to raise wages to attract and retain talent. And while a bigger paycheck is great for you and me, that wage growth is a direct pipeline to inflationary pressure. Businesses often pass those higher labor costs on to consumers in the form of higher prices. The bond market knows this. So when a jobs report comes out showing the economy added way more jobs than anyone predicted, and that wages are growing rapidly, bond traders get nervous. They see the engine of the economy revving into the red, threatening to overheat and spark an inflationary fire. They anticipate the Fed will have to keep its foot on the brake, keeping interest rates high to cool things down. And so, just like with a hot CPI report, they sell bonds and mortgage rates climb. Conversely, a weakening labor market, fewer jobs created, a rising unemployment rate, is paradoxically good news for interest rates. It's a signal that the engine is cooling down. It means less pressure on consumer spending and wages, which alleviates the threat of inflation. It tells the bond market that the Fed's previous rate hikes are working, and that the central bank might soon be able to declare victory and pivot to cutting rates. This is the bad news is good news phenomenon you hear about. A weak jobs report is bad news for the economy, but it's fantastic news for the bond market, leading to lower mortgage rates. The third and final gauge on our main dashboard is overall economic growth, most commonly measured by the gross domestic product, or GDP. If the labor market is the engine, GDP is the speedometer. It tells us how fast the entire economic vehicle is moving. It's the broadest measure of economic health, capturing the total value of all goods and services produced. Just like with the jobs report, strong GDP growth is a sign of a robust, expanding economy. But again, to the bond market, it's a warning. A rapidly accelerating economy can stoke the flames of inflation. It signals that demand is high, businesses are thriving, and there's little need for the Federal Reserve to stimulate the economy with lower interest rates. In fact, it suggests the opposite, that the Fed needs to maintain a restrictive policy to prevent things from getting out of control. So a blockbuster GDP report will almost always send bond yields and mortgage rates higher. On the flip side, a report showing slowing or, even worse, negative GDP growth is a massive green light for the bond market. It's the clearest sign that the economy is decelerating. This is when you hear the word recession. And a recession is the bond market's absolute best friend. Why? Because during a recession, inflation almost always collapses. Demand dries up, unemployment rises, and prices fall. The Federal Reserve, in response, pivots from fighting inflation to trying to save the economy, and it does that by aggressively cutting interest rates. Furthermore, during times of economic fear and uncertainty, investors pull their money out of risky assets like the stock market and flood into the safest investment on planet Earth, U.S. government bonds. This massive wave of buying is called a flight to safety. This huge demand for bonds sends their prices soaring and their yields plummeting. This is why, historically, the lowest mortgage rates of a cycle are found in the depths of a recession. So let's put it all together. You now have the dashboard. You have the inflation gauge, CPI, the engine status jobs report, and the speedometer, GDP. These are the primary data points the bond market uses to make its bets. It's a constant, real-time calculation. Is inflation too hot? Is the job market strong enough to keep it hot? Is the overall economy growing so fast that it's adding fuel to the fire? The bond market is constantly asking these questions and trying to guess what the Federal Reserve will do in response. It's a high-stakes game of prediction. The market isn't reacting to what the Fed did last month. It's reacting to what the data today suggests the Fed will be forced to do 3, 6, or even 12 months from now. That's why you see mortgage rates move so violently on the day these reports are released. The market is instantly repricing the entire future path of interest rates based on that single new piece of information. This is the pulse of the market. And by learning to read these 3 gauges, you can begin to feel it too. You can start to understand the why behind the headlines, moving from a passive observer to an informed participant in your own financial future. But understanding those 3 indicators is just the first layer. It's like knowing the rules of the game, but to truly understand the game, you have to watch the players. And in the world of economics, the players are driven by something far less predictable than data points: human emotion. This is where market sentiment and consumer confidence come into play. Think of market sentiment as the collective mood of investors. It's the vibe in the room. Are people optimistic, buying up assets and taking risks? Or are they fearful, selling off investments and hoarding cash? This sentiment can become a self-fulfilling prophecy. If everyone believes the economy is heading for a downturn, they'll stop spending and investing, which can, you guessed it, cause a downturn. This is why you'll see rates sometimes move in ways that seem to defy the hard data. A sudden wave of fear, sparked by a bank failure or a scary international headline, can send investors flocking to the safety of treasury bonds, temporarily pushing yields and mortgage rates down, even if inflation is still high. Closely related is consumer confidence. This measures how you, me, and our neighbors feel about our own financial prospects. Are we confident we'll have our jobs in 6 months? Do we feel secure enough to make a big purchase like a car or a new home? When consumer confidence is high, people spend money. They go out to eat, they book vacations, they buy houses. This spending fuels the economy, which can push inflation up and lead the Fed to keep rates higher. But when confidence plummets, wallets snap shut. People save their money, pay down debt, and put off major purchases. This slowdown in spending can act like a brake on the economy, helping to cool inflation and eventually giving the Fed a reason to cut rates. So, when you see a consumer confidence report, don't just see it as a statistic. See it as a nationwide survey of financial courage. It's a leading indicator of where our collective behavior is about to steer the economy. And finally, there's the ultimate wild card: geopolitical events. These are the external shocks that nobody can predict. A war in a major oil-producing region can cause energy prices to skyrocket overnight, impacting inflation across the globe. A global pandemic can shatter supply chains, creating shortages and price spikes for everything from lumber to microchips. A major trade dispute can trigger tariffs and disrupt the flow of goods, changing the economic calculus for entire industries. These events don't follow economic models. They rip up the playbook. They force central banks and governments to react, often in dramatic fashion. A geopolitical crisis can instantly change the priorities of the Federal Reserve, shifting its focus from fighting inflation to simply ensuring financial stability. This is the chaos factor. It's the reminder that no forecast, no matter how sophisticated, is ever truly certain. The world can and does change in an instant. So we've journeyed through the core data, inflation, the Fed's actions, the Treasury market. We've layered on the human element of sentiment and confidence. And we've acknowledged the unpredictable nature of global events. The question you're probably asking now is, so what? What do I do with all this information? The answer is both simple and profound. You stop trying to time the market. You stop waiting for the perfect moment, the mythical day when rates hit rock bottom. Because even the most brilliant economists on the planet, with access to all this data and more, consistently get their forecasts wrong. The goal of understanding these indicators isn't to give you a crystal ball to predict the future. It's to give you a compass to navigate the present. It's about shifting your focus from the things you cannot control to the things you absolutely can. You cannot control the consumer price index. You can't call up the Fed chair and tell him what to do. You can't influence the global bond market, but you can control your personal economy. You can control your credit score. A higher score can unlock a significantly lower interest rate, saving you tens of thousands of dollars over the life of your loan. That is a rate cut you give yourself regardless of what the Fed does. You can control your savings rate and the size of your down payment. A larger down payment reduces the lender's risk, which can lead to better terms and lower monthly payments. You can control your debt-to-income ratio. Paying down high-interest credit card debt or a car loan before you apply for a mortgage makes you a much stronger borrower in the eyes of any bank. This is where the real power lies. While the world is busy reacting to headlines, you can be quietly building a bulletproof financial foundation. When you focus on your own balance sheet, you make yourself resilient. You put yourself in a position where you can act when the time is right for you, not when a pundit on TV tells you it is. And part of controlling what you can is building the right team. Find a fantastic, experienced loan officer and a knowledgeable real estate agent. These professionals live in this world every single day. They understand the nuance behind the numbers. They can translate a change in the 10-year Treasury yield into a tangible strategy for your offer. They can help you understand when it might make sense to lock in a rate, or what loan products might be best suited to the current environment. They are your personal guides through the economic wilderness. Ultimately, it's about perspective. In the short term, mortgage rates are a roller coaster, driven by this complex interplay of data, emotion, and global events. Can be dizzying, but if you zoom out, the picture changes. A house is not a short-term trade. It's a long-term asset. It's a place to live, to build a life, to create stability. The rate you get today is just one chapter in a 30-year story. This brings us to one of the most powerful concepts in real estate. Marry the house, date the rate. You find the home that is right for your family, in a location you love, for a price you can truly afford. That is the long-term commitment. That's the marriage. The interest rate? That's temporary. That's the date. If rates are high when you buy, you make the payment work for your budget. And then when the economic cycle turns, and it always turns, and rates eventually come down, you refinance. You trade in your old high rate for a new lower one. You don't pass up on the right house for you because you're scared of a rate that is, by its very nature, temporary. We started this journey trying to understand the forces that drive mortgage rates. We looked under the hood of the economy and saw the engine. The heat of inflation, the steady hand of the Federal Reserve, and the real-time pulse of the Treasury market. We learned that this machine is operated by humans, with all their hopes and fears, and that it exists in a world full of unpredictable shocks. The purpose was never to turn you into an economist. It was to demystify the process, to strip away the fear and confusion that often surrounds these big financial decisions. Because knowledge replaces fear with confidence. The next time you see a headline about the latest inflation report, you won't just see a number. You'll understand what it means for the federal. The next time the Fed makes an announcement, you won't just hear jargon. You'll understand how it's meant to influence the economy. And the next time you see mortgage rates tick up or down, you won't just see a price. You'll see the story behind it, the story of a complex, dynamic, and deeply human economic system. And knowing that story is what empowers you to stop being a passenger and start being the pilot of your own financial journey.